He draws on over 4 decades of experience to help clients with ESG risk compliance, management systems, internal controls, reporting, audit readiness, and auditing. Current focus areas include GHG emissions, forced labor, and conformance with new and emerging rule standards, including the SEC proposal. Doug brings a unique perspective to compliance, drawing from experience in operations and corporate compliance, environmental and sustainability auditing, internal auditing, and external assurance for ESG issues, with a Big Four firm and leading conflict minerals assurance audits with his firm. 4 lines of defense. He was on the Volkswagen Monitor team involved in the transformation of environmental compliance and management. He's active with the Institute of Internal Auditors, contributing to thought leadership, webinars, and ESG workshops. He authored the first piece on environmental fraud for the BNA Environmental Reporter. He's on a core team updating COSO's guidance on linking the internal controls framework to ESG. Doug holds the fundamentals in sustainability accounting credential granted by SASB, Certified Risk Management Assurance Professional by IIA, and is a certified professional environmental auditor. It's a pleasure to welcome Doug Hileman.
A lot of research lately, and one thing I'll share with you is that A4S and KPMG, I think the slides are available, my slides will be available, and these organizations have fantastic content on their websites. The slide decks that you've seen today are among the best I've seen in the last couple of years, so you are really getting a terrific motherlode of information here this afternoon. And I'll put in a plug for my own website. That I have a 50-minute webinar there that was sponsored by the Institute of Internal Auditors on the proposed climate change rule. So that's about 10 pages a minute. I think that's pretty thrifty, so you can slam through that in about 50 minutes and you'll have a very thorough working knowledge of it. And watch for, does anybody here, do you know COSO? Anybody heard of that? A few folks. COSO is sort of a funny organization. It's an amalgam of organizations, really, big committee of sponsoring organizations. That in the wake of one of the financial meltdowns we've had over the decades, they had to come up with, well, what does internal controls over financial reporting look like? So there's an internal controls framework, financial reporting, that's very prominent in Sarbanes-Oxley world. And the board decided, shouldn't we have something for internal controls over sustainability reporting? So that is in the works, and that'll be published in January. And I'm pleased to say that I'm one of the technical writers and the ESG specialist on that team. So stay tuned for more. So after listening to some folks who have really made major strides in changing the world, I guess I'm next in line, and I'm going to bring it down home with some things that are really just much more practical and hands-on from my own experience. I did my first environmental audit in late 1970s and first supply chain audit about the same time. I was hired to join PwC in 2002, about a month before Sarbanes-Oxley was passed, as an environmental specialist, also an engineer working at an accounting firm, so kindred spirits here, trying to figure out what the hell are these accounting rules all about. But I had to figure it out, and we figured it out. We did what wasn't done before. And coincidentally, I wrote my first sustainability report in 2002. It was kind of odd going from the assurance side of the house and work on financial audits and go to the advisory side of the house and work on sustainability reports. And I thought, well, they're kind of the same, but they're not the same. And one of the differences was that the maturity of controls and systems and data sources and even people understanding what it was for financial reporting was much more mature. And I thought, well, that kind of makes sense because financial reporting has been around essentially as long as there's been money. But sustainability reporting is a little new to the game, so we've got a long way to go. So over the years, I hope to share with you a couple of things on how they're the same and how they're kind of not the same. There is some convergence. I kind of have a different opinion on whether we'll get all the alphabet soup down to one alphabet, or there will continue to be a number of them, or maybe more, who knows. But I am not a CPA. I work with a lot of CPAs and maybe even played one on TV for a while. Thank you everybody for covering this so we can breeze right through these slides. We all know what it is. I think of an ESG, there are a couple faces in this room I think that might recognize the Dewey Decimal System. That I think of ESG almost as a taxonomy for all things non-financial. And the common investor, all investors are interested in making money, but folks are increasingly interested in something else too. So if you're really interested in gender equality, if you're really interested in commitment to veterans, if you're really interested in a particular issue, where do you go in this whole pillar to find things? Where do you find what you're looking for? And some things really transcend these pillars or categories, if you will. Environmental justice is environmental and it's social. Well, we have to find a place to park it so that we can report and disclose on these topics. I think of it as kind of a taxonomy. And one of the things I also have noted is that, you know, financial reporting, you report at the end of the year what your sales were, what your costs were, what your assets are, what your liabilities are. Reporting comes at the end of the cycle. But in sustainability, the demand for information has started with the demand for reporting. There's been such phenomenal pull for data and information, and in many cases that pull has run faster than what organizations are doing. You know, so really the caboose is driving the train a little bit in terms of ESG reporting, so that's been kind of different. Every organization goes on a journey. There's one, so there's so much reporting, there's so many stakeholders looking at the reporting in all the different channels. They're looking at it for different reasons. So, you know, what are we supposed to do as an organization? I tend to work more on the preparer side. So all these people are looking at all these things make all these different decisions. So it is anything but a one size fits all. One report, I don't think, is going to cut it for all the stakeholders who are looking at all this data and information for all the different reasons. But one thing is kind of converging, that the investment community is looking at many sources to see what organizations are doing about ESG issues that affect their ability to make money. That's really where the investors start. They might add to it, but all the investors are interested in the effects on making money. So I have noticed over the years, there are three attributes of ESG reporting that I contend are a little different from financial reporting. I noticed this first one, control and influence. Organizations, you know what your sales were, you control your sales, you control it through a portal, you control it through sales reps. I noticed this in 2015, the ISO Environmental Management System standard was updated, and they were very clear that they expected, and frankly they had always expected, that an organization's environmental management system would consider all aspects of the environment, including how they design their product, how they engage with the supply chain and their manufacturing facility, and how their products were used, and how their products are disposed of, and what happens at end of life and after the end of life. So if you're making a dishwasher, where does the metal come from? If you're making a dishwasher, what happens to it after the end of its life? Can you dispose of it? Can you reassemble it? So this was in the environmental management systems in 2015. And these are areas that are not within the four corners of a company. The company is expected to exert influence on their business partners to change the design of the part, to look into the human rights of the fish that goes onto the shelf at Costco. So you don't control it, but you're expected to influence it and put that in your report. That's a little different from sales and expenses. Compared to financial reporting, I see much more in the way of narrative. For non-financial reporting, describe your approach to risk management. Describe your how you got to your materiality issues. Describe the arrangements describe how your cross-functional teams are organized and how you maintain them to be frequent, to be relevant on an ongoing basis. That's different from what were your sales in Brazil this year. It's very different. And the third one is it's both backward-looking and forward-looking. As an auditor, the first thing I ask is, well, what's the scope and what is the reporting period? It's typically a fiscal year, it's a calendar year, it's backward-looking, we know when it started, we know when it ends. Sustainability reporting, ESG reporting, we want to know what you are going to do about something. We want to know how you're going to get to net zero in 2040 by influencing supply chain and by coming up with your narrative on how you're going to influence the supply chain. So this is a little different from a balance sheet, and it poses some problems because, well, in financial reporting, we're used to internal controls. How do you control something you don't control? It's a little hard. What's the basis for statements and claims and narratives? We make every effort to be inclusive for the people in our supply chain and our workforce. What is that exactly? And how do you audit a promise? Here's where we're going to have 100% of our packaging out of post-consumer fiber in 10 years. Well, you just set the basis for what you have to report against for each of the next 10. How do you audit a promise 1, 2, 3 years into it? It's just different. And I find that people who work on these kinds of reports, we had great discussion here from Jason on how these groups are starting to talk together and the finances getting involved. Sometimes I find that they kind of talk past each other because everybody knows where they come from, but they don't know how the other side is a little bit different. So I find these attributes are really interesting, and you can have all three. So it's not just a matter of additive, it can be exponential on how the differences add up. So we had a great question before about alphabet soup. Here's a couple letters in the alphabet. There are all these different reporting standards and frameworks, and every one has its own purpose. So they're looking for specific pieces of data, specific trends, specific performance. But I'd like to focus a little bit on reporting for the capital markets. Just going to go to the capital markets here. We saw this graphic before. Thank you for somebody putting this up there so I don't have to explain the 3 boxes here. I'm going to come back to this a little bit in a minute. On the financial reporting, as I call them, disclosures, and other things that impact materiality. I've got kind of a different take on this graphic, and one of these weeks soon I'm going to finish a white paper that I think there really should be 7 shapes up here and not 3. So I'm going to disaggregate things when everybody's trying to collect things. I really think we need to disaggregate it a little bit. The 3 here are what you've accustomed to seeing before, and impact investors. A lot of folks do scour the web, use services like the one we just heard about, and make their own decisions, but I'm really interested about your LGBTQ equality. But I really want to know if your ESG fund has a single dollar in for-profit prisons. Well, I don't care about issue X, but I really care about issue Y. And companies are just inundated with surveys from impact investors, where what's material to them is really material to them. It's not the materiality threshold that accountants typically look at, 5%, 10%. For them, that materiality threshold is $1. And so you will answer that survey or you won't get their money. So it's a different category of investments. And we're going to look at a few of these as we go through. And I'll just share kind of a couple hands-on examples to show you how the ESG topics of the world move into each of these categories. Now, when I was at PwC, one of my first jobs was to support financial audit teams on contingent environmental liabilities. There's laws and regulations that say if you polluted the environment, if you caused soil and groundwater contamination, you've got to clean it up and you've got to pay for it. That can take years. Well, investors want to know just how much money do you have to pay? Because that's money we can't get as a dividend. So that's a rule where you have to calculate that, you have to estimate it. Maybe you sold the company, maybe you have an insurance policy, maybe there's a caution, whatever it is, you have to come up with a number and a process to get to this number. It's an environmental issue that's on the income statement and the balance sheet, and this is subject to the audit opinion. This is subject to audit review and part of their opinion, and this has been here for 25 years. So this has been going on for some time. I was pleased that Tom introduced the topic of renewable energy credits. This is something that's kind of new. Renewable energy credits have a vintage. Those value changes over time. So what's worth $20 in 2025 could be worth $28 into the value changes every year. The accountants and tax people are going to love this, but this is now in the audit opinion. I go on my webinar into this disclosure threshold, and I have some interesting stories about this if we want to talk at break or the reception. But I'd like to go into part 2, and this is the management discussion analysis. I'm a huge fan of SASB. And SASB started out by saying, my gosh, we want these disclosures and the management discussion analysis. This is my version, not theirs. Industry said, oh, it's so complicated, we can't possibly, it's so much to do. SASB said, fine, we'll figure it out for you. So they did the kind of exercise to look for materiality by sector, came up with 10, 14 topics per sector, each of 77 sectors. So in my end, they insisted it required no new law or regulation. So kind of in my book, this is required now. So here's a couple examples of SASB disclosure topics. I think it's kind of interesting that here's one in the supply chain. Percentage of Tier 1 suppliers audited to the Responsible Business Alliance validated audit process. That's supply chain. That's something you influence. How do you control what you can't control? Come up with a nationally or internationally recognized standard or framework and get everybody to do it in a consistent way that will be decision useful. So the due diligence process becomes your control. So it's a very clever way of getting to that in a way that it's managed. The impact investors will survey you about whatever issue they want. Here's forward-looking information. Be careful about what you say here because you'll be held to this. I really would love to go into this with some of the other presenters. If we had another 3 hours to do it, we would really see some fireworks up here. And then there's other voluntary public reporting on whether it's carbon or water or diversity. These are for specific issues. And GRI is doing a major update that goes into effect for this reporting period. But I want to skip through to this chart, which I put some time, a fair amount of time into, to differentiate the things that are what I call category 1, which is on the financial statements, income statement, balance sheet, and subject to the audit opinion. Then there are the things that I call financial disclosures in the Form 10K. Now the auditors read the MD&A, but it's not part of the audit opinion. They're only looking for things that are materially inconsistent with what they saw in their procedures. For example, if a company says, we are so confident that our sales will grow in the next couple of years because of all the research and development that we have been doing, and the accountants, the auditors say, well, wait a minute. We just saw that you cut your R&D budget 30% in the last 2 years. You're not doing what you say you're doing. You can't make that statement because it is materially misleading. It's just misleading. We saw something that says otherwise. Now, they're not approving, if they change the statement, that it's not subject to their opinion. Yes, we stand behind that statement as part of our opinion. They're just looking for things that are wrong. So, are they enforceable by the government? Is it included in Sarbanes-404? Is it relevant for the impact investor? That ESG reporting are things like the GRI, the Carbon Disclosure Project, the reports that you submit to the Human Rights Coalition, anything else that is going out for general purpose use that is public record and can be scoured and analyzed as part of benchmarking, even though it's not regulatory. It's a data point for analysts and for investors to consider on, do I put my money in? Do I go to work for this company? Do I engage with this company as a business partner? Do I write an insurance policy for this company? All this is public, but it's not enforceable by the SEC. But it could be enforceable by a customer who decides they don't want to do business with you. Your product's not going on the end cap in their store. So there are a couple other provisions in here for the governance model, a common internal audit role, other audits that are done, and who has responsibility. We heard a lot more about the organization. It's kind of all over the place right now. I'm a huge fan of cross-functional teams because it touches so many different things. And my experience in being a coach or shepherd, as you call it, for the cross-functional teams is half the time people will show up and they don't know why they're there. They don't know what they're supposed to be doing. They don't know how to talk to each other. And people from sales will say, I don't know why I'm here. It's like, yeah, we know why you're here, because you can't say things about our product that you can't support. R&D and procurement goes, procurement. All I'm looking for is time, delivery, price, quality, and delivery. No, you now have to look out if you've followed the Uyghur Forced Labor Protection Act. Anybody heard of this? You will. It was introduced by all people, Marco Rubio, last year and passed in Congress, in this Congress, with one dissenting vote. When does that ever happen? Never. One dissenting vote. In the Dodd-Frank Conflict Minerals Rule, it was required that companies do due diligence on tin, tantalum, tungsten, gold, and go through your processes to see to it that you're not using forced labor in the Democratic Republic of Congo or other countries in the vicinity. In the Uyghur region of China, the consensus is there are about 3 million people in forced labor situations, and coming from that part of the country are cotton, tomatoes, and high-grade silica. About 30% of the world's supply of silica comes from China. So, if you are importing anything that contains any of those 3 products or anything that comes to be known from that area, you are obliged to demonstrate that it did not come from the Uyghur Autonomous Region of China. If you cannot demonstrate that, Customs and Border Protection is authorized to impound your shipment at the port where there's all this surplus room where nobody knows what to do. You know, there's no room at the ports. So your cargo will be held at the border under a hold and release order until you can prove that it did not come from that region of China. It's a game changer because it creates the rebuttable presumption that your product did come from the forced labor area unless and until you can prove it did not. Very different. So if you start to wonder why you can't get a car, a dishwasher, or anything with a chip, that's part of the reason. Low impact, low value cotton is already not used in Q-tips anymore because there's no cotton. It can't come into the country. So we're already seeing changes in this, and you know, that's so now in ESG reporting and primary responsibility, you know, that was just something, procurement, we don't have to look for that. Well, yes, you do. Now that has to be part of your supplier audit and your due diligence and risk management. So they're alike in some ways, they're different in some ways. It really helps if these cross-functional teams are so useful to try to get people to talk the same language. For the things that are material and going to go in your financial statements, really learn that Sarbanes-Oxley internal controls. For things that are going into the management discussion analysis on the disclosures, get to know your controller and make sure you can back it up. And yet, there's a lot of stuff going to other stakeholders for their needs. You have to have support for it anyway. And even however you slice and dice the information, you have to go back to one of those slides, in my view, and say, make sure that what you're reporting is fit for purpose. And if you identify gaps where you don't have the data and information, where your strategy is not aligned with that the way you want, and circle back to the beginning of that process and go knock on the door of the board, knock on the door of management, knock on the door of finance, and get the resources you need as an organization to make it all happen. So I think that's about all I got. Thank you.